Bitcoin balances on exchanges are dropping to new lows, and this has many people calling for an imminent supply crunch that will send the price to the moon any day now. If demand is surging, with ETFs, corporations, and sovereign wealth funds all buying, why isn't the price exploding yet? Is something bigger happening behind the scenes? Is one company quietly rewriting Bitcoin's supply curve from the outside in? Today we'll dig into the real dynamics very few are talking about, and why the truth might surprise you. If you've been scrolling social media or watching YouTube videos, you may have seen the narrative that Bitcoin is flying off exchanges at unprecedented levels, and that we're days or even hours away from an absolute explosion in the price. Many of you have probably seen charts like this, showing the steep decline in exchange balances that help paint the super bullish sentiment that there will be no more Bitcoin left on exchanges at all soon, and that the God candles are coming. At first glance, Bitcoin leaving exchanges looks incredibly bullish, and in some ways it is. Less Bitcoin on exchanges usually means fewer coins available for sale, which in the past has signaled strong accumulation and major price rallies. We saw this in 2020 and 2021. Exchange balances dropped, and Bitcoin exploded from 10K to 60K in less than a year. So why hasn't the same thing happened in 2025 yet? We have Michael Saylor announcing another 15,000 plus Bitcoin purchase for his company Strategy on Monday. ETF inflows continuing to be strong, now with over 7 straight days in the green. So why, with record ETF buying, corporate stacking, and sovereign wealth interest, is Bitcoin's price not closer to $1 million than 100K? The answer? The full story is a lot more complicated. First, not all outflows are pure HODLing. In 2020, a lot of Bitcoin left exchanges straight into personal cold storage, true long-term holders locking up supply. But in 2025, much of the Bitcoin leaving exchanges is flowing into institutional custodians, not disappearing, just moving from one central entity to another. Many of these coins aren't sitting idle. They're being used as collateral for derivatives trading, ETFs, and institutional strategies, meaning they're not necessarily off the market. They're part of a new, bigger game, one that still has selling pressure attached to it. This question gets asked a lot, and Bitcoin on-chain analyst Checkmate put it better than anyone. Here's what he had to say in response to someone asking how Bitcoin isn't at $1 million yet after Saylor's latest massive purchase. At $1 million Bitcoin, the market cap is 20 trillion and approaching gold size. Saylor buying 15,000 coins for 1.4 billion is 12,860 times smaller than the $18 trillion market cap change needed. Spot sellers are consistently underestimated. 10,000 coins aged 6 months or more moved yesterday alone, and that is considered a slow day. Approximately 30% of all on-chain volume is a deposit to an exchange. So assume 3,000 Bitcoin per day sold versus Saylor's 15,000 Bitcoin buy is 5 days of spot sell pressure from long-term holders. And that ignores the short-term traders who are as large, so add an additional 3,000 Bitcoin per day sell side. As it turns out, people sell lots of Bitcoin every single day. And one large bidder just isn't enough to squeeze the price up to gold parity overnight. Now, I used a lot of Checkmate's analysis as inspiration for this video, so give him a follow and check out his newsletter for some high-signal on-chain analysis. So in summary, Bitcoin has moved from being a tiny, insignificant player in the global capital markets to a nearly $2 trillion asset. Still small, but no longer insignificant. With a bigger market cap, it takes much larger Bitcoin buys to move the needle. Additionally, sell-side pressure is almost always underlooked in the Bitcoin bullish circles. At the end of the day, Bitcoin is still a market. And like any market, price is where buyers and sellers meet. As Checkmate points out, short-term sell pressure is still elevated, whether it be speculators who don't know what they own, traders trying to make a quick buck, or long-term holders shaving some off and taking profit. There are always sellers on the other end of every buy. So what does this all mean? Yes, Bitcoin's tightening supply is real, and it is bullish. Yes, it's setting the stage for a massive move. But supply alone doesn't move the market. Demand lights the match. If fresh spot buyers, ETFs, sovereign wealth funds, and retail investors keep stepping in, Bitcoin could rip higher than most people expect. And it could happen very quickly. But if demand slows down, or if over-leveraged traders get liquidated, Bitcoin could see violent swings in the opposite direction too, even if the long-term fundamentals remain unchanged. So the fuse is lit, but the direction isn't guaranteed in the short term. That's why it's critical to gain conviction by learning what it is that you own, to stay humble, keep stacking, and to stay patient. We're not here for the hype cycles. We're here because Bitcoin's absolute scarcity, its hard-coded, unchangeable 21 million limit, is the greatest monetary innovation in human history. Supply shocks will come. Volatility too. But if you stay focused on the signal, not the noise, you'll see why time in the market always wins over trying to time it. Keep stacking sats, stay humble, and be patient. The best chapters of Bitcoin's story are still ahead. And if you want to be a part of shaping that future, join us this September for BTC in DC, the first major policy forum for Bitcoin in the US. Swan is proud to partner with George Washington University and BTC Prague to bring together leaders like Michael Saylor and Adam Back to talk about Bitcoin and its role in the future of global finance. The Swan private team is helping host the event, and we're excited about seeing clients there, so don't miss it. Get your tickets at btcndc.com and help usher in the Bitcoin era. And a quick shout out to Mara, the largest publicly traded Bitcoin miner, for supporting this show and for helping make Bitcoin the world's most decentralized and secure monetary network. So I've got one more bullish bit before we close today. I don't want you thinking that these huge institutional buys are doing nothing and that sell-side pressure will always meet demand, because that's not true. Bitcoin will continue to trend up due to its increasing scarcity and also due to increasing demand. I came across this post on X by Adam Livingston, who posts that huge buyers like Michael Saylor's Strategy and brand new player 21 Capital are synthetically having Bitcoin's supply on top of the 4-year supply halvings. I won't read the whole thing, but I'll summarize his thesis, which is pretty fun and bullish, and I recommend following Adam on X for other great rants like this. The thesis goes something like this. Michael Saylor and MicroStrategy aren't just buying Bitcoin anymore. They're reshaping Bitcoin's supply curve. Miners today are only producing about 450 new Bitcoin per day. That's about 13,500 new coins per month. But Strategy is raising billions through stock sales and debt offerings, and using that firepower to aggressively outbid the market for fresh coins. If they keep buying 30%, 40%, even 50% of the new Bitcoin supply every month, what happens? It's like another halving event. Except this time, it's manual. No waiting 4 years. No relying on code. Just pure financial muscle, pulling Bitcoin out of circulation faster than miners can create it. It means the effective supply for everyone else, ETFs, corporations, sovereigns, regular investors, shrinks dramatically. And it happens every single time Saylor deploys capital. Over the past 6 months alone, MicroStrategy has been accumulating Bitcoin faster than miners can produce it. They're not just stacking Bitcoin, they're selling the future cost of capital for the entire world. In a world where Bitcoin becomes this scarce, access to Bitcoin will cost more. Lending against Bitcoin will cost more. Borrowing Bitcoin could become a privilege reserved for nation states and corporate giants. Strategy is positioning itself as the gatekeeper. They aren't just participating in Bitcoin's monetization, they're forging it. And if they continue down this path, the global Bitcoin economy won't be dictated by organic miner production alone. It will be dictated by the gravitational pull of the first true Bitcoin superpower. This isn't just about owning Bitcoin. This is about controlling liquidity and setting the rules for everyone else downstream. Pretty fun thesis, but again, take it in context with everything else we discussed earlier. And remember that the biggest driver for Bitcoin's price is the global money supply.
Listen, it is what it is. And this is so bullish for Bitcoin. They're going to have to print so much money. Bitcoin is really priced with how much fiat currency is sloshing around in the world. And in order for all of this to play out and work, we have to debase our currency. We have to devalue our debt, and we have to create more fiat. It's going to send Bitcoin nuclear.
Governments have to continue to print. As Jack points out, it's inevitable in order for them to service their mounting debt. And that excessive money printing will always be the most reflective in Bitcoin's price. Infinite dollars chasing a finite Bitcoin supply. It is only a matter of time before the next massive move up. But I'd love to hear your thoughts on this and the supply crunch. Do you think we're on the verge of a massive move up? Or is something bigger brewing beneath the surface? Leave your comments below, like this video, share it with friends, subscribe to the channel, and hit that notification bell so you don't miss the next video. Thanks for watching, and remember, TikTok next block.